Ladies and gentlemen, imagine a world where the financial system is on the brink of collapse, where economic chaos is just one misstep away. Now picture an institution born from the ashes of crises, standing as the steadfast guardian of stability, guiding the nation through turbulence and triumph alike. This is the power of the Federal Reserve, an institution that shapes not only our economy, but the very future of global finance. In the next few moments, you'll discover how one law transformed the nation's financial system forever, and why it remains the cornerstone of American prosperity. Stay with us, because the story of the Federal Reserve is a story of resilience, innovation, and the heart of America's economic might. And the enactment of the 1913 Federal Reserve Act marked a pivotal moment in the financial history of the United States, establishing a central banking system designed to address the inherent instability of the nation's monetary system. The act sought to create a more structured and controlled banking environment, responding to the periodic financial crises that had plagued the nation. It authorized the creation of the Federal Reserve System, a centralized institution with the mandate to regulate the nation's money supply, oversee the banking system, and provide a more stable and flexible economic structure. This regulatory framework granted the Federal Reserve the authority to issue currency, thus consolidating the power to control the nation's monetary policy, previously fragmented across various state-chartered banks. The Federal Reserve's ability to adjust interest rates and manage inflation was designed to prevent excessive speculative practices and to stabilize the financial system. In addition to strengthening the central control over currency, the Act introduced mechanisms to protect the public and the economy from the detrimental effects of bank failures and panics. One of its core features was the establishment of a decentralized system of reserve banks, each tasked with serving particular regions of the country, ensuring more localized access to financial resources while still maintaining a unified national policy. Furthermore, the creation of the Federal Reserve as an independent entity removed it from political influence, ensuring that its decisions on monetary policy could be made based on economic considerations rather than political pressures. The Federal Reserve Act also provided the necessary legal framework for the government to step in during periods of economic downturn, equipping the central bank with tools to inject liquidity into the economy, thus providing a backstop during times of crisis. The financial reforms set forth in the Federal Reserve Act played a critical role in modernizing the American banking system, marking the beginning of a more robust, systematic approach to managing the nation's financial operations and directly influencing the regulatory mechanisms that would govern the economic landscape in the years to follow. The passage of this act was a response to the growing complexity of the nation's economy and a recognition that the previous fragmented system of banking was no longer sufficient to safeguard against the potential for economic collapse. Through these reforms, the Act helped to shape the framework for the United States' financial stability and economic growth in the 20th century. And the framework established by the Federal Reserve Act was not merely a response to the immediate banking challenges of the time, but rather a visionary step towards shaping the long-term stability and prosperity of the nation's financial system. The Act provided the tools necessary for managing the nation's monetary policy, empowering the Federal Reserve to be a pivotal force in the regulation of the U.S. economy. It laid the foundation for a central institution that could act swiftly and decisively in moments of financial uncertainty, providing the means to manage economic cycles and to ensure that the economy remained resilient in the face of crisis. The flexibility granted to the Federal Reserve allowed it to adapt to changing economic conditions and to take necessary actions to protect the financial system from becoming vulnerable to uncontrolled speculation, inflation, and panic. And by establishing a central authority over monetary policy, the Federal Reserve was able to foster greater confidence in the nation's banking institutions. It provided a clear structure for how currency would be managed and circulated, reassuring both businesses and consumers that the value of money would be stabilized and that they could trust the financial system. This was especially critical in times of economic instability when people's trust in financial institutions could be shaken. By introducing the concept of lender of last resort, the Federal Reserve gave banks a safety net, reducing the likelihood of catastrophic failures in times of crisis and providing reassurance to depositors. This shift in policy also marked a turning point in how banks interacted with one another, setting the stage for cooperation over competition, with the reserve banks working together to ensure the financial stability of the country as a whole. And the ability to adjust interest rates and regulate the money supply gave the Federal Reserve the power to directly influence economic activity, to stimulate growth during recessions, and to cool down the economy during periods of inflationary excess. This innovative tool of monetary policy allowed the Federal Reserve to play a role far beyond just maintaining currency stability. It became an active participant in managing the growth trajectory of the American economy, strategically intervening when necessary to prevent excessive inflation or deflation, while supporting economic expansion in periods of stagnation. It was this role that enabled the United States to navigate the volatile economic environments of the 20th century, from the Great Depression to the post-war boom. And moreover, the decentralized nature of the Federal Reserve with its regional reserve banks provided a unique advantage. It brought monetary decision-making closer to the local economies that it was designed to serve. This decentralized structure allowed for a better understanding of the economic needs of various regions, and the reserve banks were able to tailor their interventions to the specific challenges faced by local economies. It was a model that balanced the necessity of a centralized authority with the practical benefits of regional insights, ensuring that all parts of the nation were represented in the monetary decision-making process. And through its consistent actions and economic foresight, the Federal Reserve gradually became a pillar of trust in the United States financial system. The reforms introduced by the 1913 Act laid the groundwork for economic policies that would allow for not just financial stability, but economic prosperity as well. By providing a reliable and predictable framework for monetary policy, the Federal Reserve helped foster an environment conducive to growth, investment, and innovation. Its influence can be seen in the robust economic cycles that followed its creation, the steady increase in national wealth, and the resilience of the American financial system in the face of global challenges. And the impact of the Federal Reserve Act was not only profound but far-reaching. It shaped the regulatory environment of not just the United States, but also influenced financial systems around the world. Its legacy continues to define modern banking and finance, proving that through thoughtful and strategic reform, it is possible to create a system that stands the test of time. The strength and foresight of those who shaped this legislation serve as a reminder of the importance of creating institutions that serve the greater good, ensuring stability, prosperity, and confidence in the economic structures that form the backbone of a nation's success. And the actions of the Federal Reserve, empowered by the reforms of the 1913 Act, had an enduring and transformative effect not only on the economy of the United States, but also on the global financial landscape. With its regulatory influence, the Federal Reserve helped establish a model of economic management that was both dynamic and responsive to the challenges of an ever-evolving financial environment. As it continued to refine its role in the years following the Act's passage, the Federal Reserve demonstrated that it was more than just a stabilizing force. It became a proactive entity steering the nation through a multitude of challenges, from the Great Depression to post-war economic recovery, and even navigating the complexities of the modern-day financial crises. And what made the Federal Reserve's power so significant was its ability to anticipate and respond to economic trends. By maintaining control over monetary policy, it was able to mitigate the adverse effects of speculative bubbles, excessive inflation, and deflationary pressures. During times of economic uncertainty, the Federal Reserve acted as the anchor, ensuring that banks had access to liquidity, which in turn helped maintain consumer confidence and allowed businesses to continue operations. By stabilizing the money supply, it prevented financial markets from descending into chaos, fostering an environment where businesses could plan with greater certainty and individuals could invest with confidence. The ability of the Federal Reserve to influence interest rates became one of the most powerful tools in its arsenal, with its decisions rippling across the global economy, affecting everything from stock market performance to consumer spending, business investments, and even international trade. And as the global economic system became increasingly interconnected, the influence of the Federal Reserve extended beyond the borders of the United States. The stability that the Federal Reserve provided to the U.S. dollar made it one of the key reserve currencies in the world. This created a situation where other countries looked to the Federal Reserve for guidance in times of financial uncertainty. By setting an example of sound economic governance, the Federal Reserve became a key player on the global stage, helping to shape international monetary policies and frameworks. The Federal Reserve's actions during times of global crisis, such as the 2008 financial meltdown, demonstrated its ability to adapt and lead in a rapidly changing economic world. The ability to inject liquidity into markets, coupled with its transparent decision-making processes, enabled the Fed to gain the trust of both domestic and international investors, fostering a sense of confidence that is essential to the smooth operation of the global financial system. And the Federal Reserve also played a crucial role in building a culture of financial stability, not just through regulation, but through its educational efforts. By providing information to the public, business leaders, and policymakers, it empowered individuals and institutions to make informed financial decisions. This emphasis on transparency and financial literacy helped to build a system where economic actors understood the implications of their decisions and the broader impact they had on the nation's financial health. And one of the remarkable achievements of the Federal Reserve Act was its ability to foster collaboration between private and public sectors. The reserve banks, while operating under the overarching authority of the Federal Reserve, had the autonomy to serve their regional economies in a way that aligned with national policy objectives. This hybrid structure, combining both centralization and decentralization, became a hallmark of the system's success. It allowed for the integration of local perspectives with a national framework, ensuring that the diversity of the U.S. economy was represented in its financial policies. This structure allowed for a more balanced and equitable approach to economic management, ensuring that the benefits of financial stability were felt across all corners of the nation, from bustling metropolitan centers to more rural and underserved communities. And the Federal Reserve Act, in its far-reaching impact, established a framework that would continue to evolve with the changing needs of the economy. As new challenges arose, whether in the form of inflationary pressures, systemic risks, or unforeseen global events, the Federal Reserve's ability to adjust its policies demonstrated a level of foresight and resilience that proved critical to the country's prosperity. The reforms of 1913 laid the groundwork for a financial system that has withstood the test of time, providing stability and security for generations of Americans, and setting a global standard for sound economic management. The work of those who created this institution stands as a testament to the power of thoughtful, deliberate reform, the benefits of which continue to be realized by the American people today. And the Federal Reserve's influence over the course of American history has proven not just transformative, but foundational to the country's economic success. As it evolved and adapted to the shifting tides of global and national economic conditions, the Federal Reserve remained steadfast in its mission to ensure financial stability. Its policies, crafted with an eye on long-term goals rather than short-term fixes, became an essential element in the construction of a resilient and adaptable economy. The Reserve's role in moderating boom and bust cycles demonstrated the efficacy of central economic management. Through measured intervention, it balanced the forces of inflation and recession, which, left unchecked, could have caused untold hardship to millions of Americans. And in the face of uncertainty, the Federal Reserve acted as a guiding force, encouraging confidence even in the darkest economic times. For instance, during the Great Depression, when the stock market crashed in 1929 and the ensuing economic collapse shook the foundations of the country, the Federal Reserve's ability to provide liquidity, stabilize banks, and restore confidence was crucial to beginning the long recovery. Despite its early struggles and the challenges it faced, the Federal Reserve's actions in later years, such as during the 2008 financial crisis, showcased its ever-developing ability to respond to a rapidly changing economic landscape. By employing policies such as quantitative easing and low interest rates, the Federal Reserve demonstrated its capacity to take bold, unconventional actions to prevent an economic collapse that could have set back the country by decades. And the continued adaptation of the Federal Reserve in times of crisis reflects the institution's dynamic role in shaping national and global economic policy. The financial crises of the 21st century underscored the importance of a centralized authority in managing the complex interplay of global financial markets. The Federal Reserve, acting not only in the interest of the United States, but in the interest of global financial stability, collaborated with other central banks to stave off a worldwide collapse. This collective approach highlighted the growing interdependence of the global financial system, with the Federal Reserve becoming an indispensable pillar in the global effort to maintain economic equilibrium. The coordination of monetary policy with international counterparts ensured that American policies were not just reactive, but part of a larger framework of global financial governance. And however, the influence of the Federal Reserve did not just extend to moments of crisis. Its steady hand in guiding the economy during periods of growth allowed the U.S. to thrive in the latter half of the 20th century. By fostering an environment where inflation was kept under control and unemployment remained low, the Federal Reserve provided the stability necessary for economic expansion. Businesses were able to grow, investments flourished, and the average American saw improvements in their quality of life. Through these sustained periods of growth, the American economy cemented its position as a global powerhouse, setting a standard for economic prosperity that other nations aspired to. And furthermore, the Federal Reserve's success lies not just in its actions during crises or moments of stability, but in its commitment to maintaining a balanced approach to the economy. Its role was never to micro-manage, but to guide, ensuring that the forces of supply and demand could function within a framework that promoted equity and growth. By managing interest rates and responding to fluctuations in inflation, the Federal Reserve cultivated an environment conducive to innovation, entrepreneurship, and investment. This approach helped the U.S. maintain its competitive edge in global markets and solidified its position as the world's largest and most influential economy. And as time went on, the Federal Reserve's ability to manage its role in the context of the evolving global economy became increasingly evident. It was not merely a domestic entity. Its policies rippled across continents, influencing trade, investment flows, and international financial markets. In moments of global uncertainty, the Federal Reserve's actions often became the benchmark for other nations, demonstrating the enduring influence of the institution. Through its unwavering commitment to its founding principles, economic stability, financial security, and national prosperity, the Federal Reserve ensured that the American economy remained a beacon of hope and stability in the ever-changing landscape of global finance.